Hello again. So here we are in chapter 20, earnings per share chapter, weighted average shares outstanding, diluted earnings per share. I'll look at the homework here in Pearson. Let me see if I can share that screen. Here it is. Hopefully you can see that. I believe you can. First question here, there's only 7. Cordova began the year with 190,000 shares, issued 79,200 on April 1, 21,000 shares on October 1, and had a 2-for-1 stock split on August 1. So this is similar to what you saw in the PowerPoint. So what is our weighted average number of shares? Well, as you can see there in this column for number of shares outstanding, 559,400 is what's on the balance sheet. But the question is, we want to do the weighted average shares outstanding. So if we have 190,000 shares for 12 months, that's 190,000 shares here. So we're going from left to right. Then we've got new issue 79,200 for 9 months because that's on April 1. So you got 9 months, April through December, right? 59,400. So we've got total before the stock split is 249,400. If it's a 2-for-1, then we're going to add 249,400 to that. So after the stock split, we have 498,800. It's retroactive. And if that had said stock split or stock dividend, it would have been the same. And we have an issue on October 1 of 21,000 shares. For October, November, December, so 3/12 of this new issue is 5,250. So our weighted average shares outstanding is 504,050. All right, here's another one for weighted average shares. Began the year with 78,000 and implemented a 9% stock dividend on January 1. So that's the very first day of the year. So 78,000 times 9% plus the 78,000 is your 85,020, right? 78,000 times 1.09 is 85,020. Also says here that we had 80,000 options that were granted on March 1. So these options were granted. Doesn't mean they were exercised. It says if exercised, right? If exercised, there will be 19,200 incremental shares. 19,200. March 1, so that is what? 10 months, 10/12 times 19,002 is 16,000. What if? Remember that whole right column is what if? Diluted earnings per share. Then we had a 3-for-1 stock split on July 1, and it wouldn't have mattered if it had been in March all the way through the end of August. It had the same impact to this exercise. And it's a 3-for-1. They do this a little bit different. So there's the 1, there's the 2 more shares. So in total, you got what? 3-for-1, $303,060, or excuse me, 303,060 shares, which is 101,020 times 3. And then finally, we have a buyback at the end of the year. September 1, we bought back 139,200 shares. So for 4 months, 46,400. 56,660. They do this a little bit different because they have both a basic column and a diluted earnings per share column, don't they? Basic meaning that you don't care about those what if scenarios on the option exercise. You do about the stock split, but diluted earnings per share, the option exercise, the only thing on here that's a what if scenario. But it's a little bit more complicated than what you saw in number 1. Number 3. Good exercise here. Maybe we'll try to do that on the notepad here if I can pull that up. Guess I need to write this stuff down here so I don't have to keep going back and forth. So we got 490,000 shares outstanding. Issued additional 60,000 on April 1. April 1 is what? 9 months left in the year, so 9/12 is 60,000. So that is what? 375% of 60,000. That's 45,000 shares. Plus 490. It should be 535,000. What's the other information here? 11,000,007. 2.5% convertible. It's a key phrase there, convertible bonds for a full year. And they give you the interest amount, don't they? You only have to calculate it. 292,500. It's 2.5% times 11.7 million. And those are converted into 332,000 shares of common. Didn't convert any of the bonds during the year because remember, diluted earnings per share is all about what if. What's out there that could have been converted. I also had 1.2 million par value, 4% non-convertible preferred stock, non-convertible. So we don't have to worry about a diluted earnings per share for preferred, but we do need to calculate the dividends, don't we? So what is 4% of $1.2 million par value? Because it's always based on par value. That's 48 something, so $48,000 of preferred dividends. 30% tax rate. Net income's 3.7 million. All right, that way I don't have to jump back and forth. We'll go ahead and write down the answers here as well. 683 and 445. Looks like it's diluted, doesn't it? So let me go over here to the scratch pad or smart pad. There it is. All right, so what's the first thing we want to do? What's our weighted average number of shares? Well, we said it had 490,000 to start with, times 12 equals 490. We also had 60,000 that were issued on April 1, so that is 9/12. And that would be what, 45,000? That we should have a denominator of 535,000 shares. Let's go over and check our answer here before we continue on. There it is, up there at the top. 535,000 shares, weighted average. Number of shares outstanding on your balance sheet is 550,000. This is what we use for earnings per share calculation. All right, let's continue on. I can probably erase that since you can see that's going to be our denominator. We can go ahead and do the basic. So the basic earnings per share on here, basic EPS is equal to my net income, which was 3.7 million, minus my preferred dividends, which we decided was 48,000. Right, 48,000, that's 1.2 million preferred times 0.04. And then my denominator is 535. $3,700,000 minus 48 divided by 535 is $6.83. So we're halfway there. Although we've done the easy half. Not really. I don't think this chapter's that difficult. I haven't done a lot of earnings per share calculations in a long time. All right, so let me go ahead and clear this off. Now we want to do diluted earnings per share. And what was convertible? Only the bonds were convertible. The preferred stock was not. So we want to calculate what is the change in the numerator for bonds. What if converted? And they told us that the interest was $292,500. That's given. We want to multiply that by 1 minus the tax rate, which is what, 0.3? Yeah. So what's 70% of 292.5? That's what we're going to add back. 292.5.7. That is 204,750. So you now have, if this had been converted, you now have more income, $204,750 more income than you had before. And that's being converted into 332,000 shares of common. So let's do our diluted earnings per share calculation. Again, we got net income, which is $3,700,000 minus the preferred dividends. That's still relevant because that's not convertible, of 48,000. But we're going to add back 204,750. We've added that to our net income because that 3.7 million net income has $292,500 of interest expense in it, net of tax. And then my denominator, number of shares outstanding, our weighted average was 535, and we're going to add back to that this what if these bonds have been converted of 332,000 shares. We're just going to do all of those individually, add them all up before you do your final calculation. So 3,700,000 minus 48 plus 204,750. That is 3,856,750. And the bottom 535 plus 332, 867. So 3,856. $4.45. And that is what I wrote down. That is correct. Diluted earnings per share. So in that case, 683 basic, 445 diluted. Conservatism principle, right? Conservatism principle says yes, that's what we want to use. It's lower. All right. Number 4. A magic pin on a string and getting tangled. Let's see here what we got going on. Should have went and showed you the solution on that other one, and I didn't. That's okay. I think you pretty much can learn from what I put on there. this is a rather long one as well, and we have to break this out into continuing operations and I believe discontinued operations. So let's just work through this one again as well. I don't have to write down all of this. That's okay. Began with 280,000 shares, 360,000 shares on September 1, September, October, November, December. So that's 4/12, 1/3 of 360. I'll be able to do that in my head. 120,000. All right, so my denominator is going to be 400,000 weighted average shares. They have 11,000,003, 2.5% convertible, full year. They give you the interest amount. Coupon interest 282.5. Converted to 155,000 shares of common. I also have 1,180,000 par value, 3%. They're non-convertible, so we don't have to worry about that for diluted earnings per share. 30% tax rate. Net income 4.1 million. And that includes a $791,000 loss from discontinued operations. So in essence, we got to add that back to get operations, don't we? I'll show you that here in a second. Try and get all this stuff down. I could probably pause this video while I write this down, but you ought to be writing this down as well. I'd be afraid I'd stop it and then that would be the end of the video. All right, do I have everything down? So the preferred is not convertible. Let's see what I want you to calculate the income from continuing operations, basic and basic for, all right, so we're doing all four. We're doing continuing operations, okay, let's go here and let me pull up the notepad. So what do we want to do first? We want to, I need to do the weighted average shares. Weighted average shares is 400,000. You should be able to do that yourself based on what I just talked you through. Weighted average shares 400,000. That's the 280,000 that were in effect for the full year. And then you had 360,000 shares on September 1. So September, October, November, December. So that's 4 months divided by 12 times 360. That's 1/3. That's 400,000. All right, so then we've got bonds here. Let's just do basic earnings per share first. What's the best way to do this? We know we had, when I get done, I'll figure out what was the best way to do it. Basic earnings per share is going to be my 48.91 You're saying, where'd 4891 come from? Well, 4891, we know our net income was 4.1 million. We said we had a loss from discontinued operations, 791. So operations is 4891. You can do this several ways. So 4891, if you want to use 4891 or 4.1 million, it doesn't, I don't think it matters. You can do it either way. Minus my preferred, and my preferred was 1,180,000 times 3%. It's going to be my preferred dividends. And that is $35,400. So that minus 35,400 divided by my 400,000 is what? 4891 minus 35,400 divided by 400,000. $12.14. Okay. So that's from operations. That's net income, and that's from discontinued ops. I don't remember which ones they're asking for, but obviously you can take each of these numbers and divide by 400,000 and get your earnings per share. So let's do the diluted earnings per share. DEPS for operations, 4891 minus 35,400. So how much are we going to add back for our interest? Well, it says that 282,000 500 times 1 minus the tax rate, which is 0.3, it's going to be 0.7, so 282.5 times 0.7 . 282.5, I fat fingered it, times 0.7, that's 197,750. So I'm adding back 197,750 because these bonds are convertible. Divided by 400. Well, that's 4891,000 minus 35,400 divided by 400 is 1263. So there's my basic earnings per share and my diluted earnings per share for operations, ops. Let's see if that's one of the questions they ask. I believe it is. Let's see. All right, so there's my basic earnings per share from income from continuing operations, right? 1214. And diluted earnings per share from continuing operations for the current year is 911. I don't remember that number. Diluted earnings per share from income from 911. 1214. What did I do wrong? 4891. Oh, I didn't add in. Oh, I didn't add into my denominator, did I? Oops. That's converted into 155,000 shares. Right? All right. Put my parentheses around there as well. It's a good habit to get into. All right, so let's go through this again. 4891,000 plus 197,750 minus 35,4. All right. So that right there, 505,350 divided by 555. $9.11. All right, so that number's correct. That number's correct. Again, this is operations, continuing operations. That's why I had to go from net income, add back the discontinued operations, plants that I've closed, facilities that have been mothballed or whatever, to get what's operations, because really that's what most analysts want to see. They don't care as much about that when they're looking at earnings per share. They're looking at operations. What's your core business doing on a regular basis? It's all important, but this one more so. All right, so we got 1214 and 911, which I believe was over here. What else did they ask for? They went on just net income for both of these. All right, well, let's just go back and do that as well. You know, I'm out of space for net income. So what do we need to do for net income? I'm going to lose all of my information here. There's a little bit up here at the top. Leave my picture. All right, so net income. Let's do this in blue. 4100,000 minus 35,4 divided by 400 is equal to $10.16. Is that our answer over here? There it is, $10.16. And so the last thing we need to work is diluted earnings per share for net income. All right. Which we can do the same thing that we did down here. Plug in 4,000,001. That should work. If I put 4 since I've run out of space. 4,000,001. Because again, we're doing net income now. Minus 35,4 plus 197,750 divided by 555,000. That says it is 768 for net income. Yep. All right. So that's got it. Then they want you to actually get my face out of the way again. Then they want you to show an income statement. There's your 4891, right? I've already done that. Remember doing that on the scratch pad? 4891, 791, net income, but you went in reverse order. There's your earnings per share we just calculated. Now the $1.98, that's just your plug number. It's like the $1.43. But interesting enough, when you look at that, we could have actually just calculated the 791, couldn't we? Divided by weighted average. We go back over here. What if we took that 791, which I've marked through, what if we took that 791 and divided that by 400,000? That's $1.98. My face keeps getting in the way. See what I'm saying? This is just another way you could have done this. 791 divided by 400,000. That's $1.98. And you could have done the same thing down here. You could have taken the 791 divided by 555. You don't have to do this. And that is $1.43. But you could have done that instead of doing these calculations up here, like this one and this one. You could have gotten the $1.98 and the $1.43. $1.98 and $1.43 to get your net income or your income from continuing operations. So you can work that several ways. All right, that was a long one. You know what, this is number 4, 3 more. I don't know why, but the chapters that students struggle with, it seems to be chapter 14, which you've got behind you on bonds payable, although some of you did very well on that. I think 20% made an A. Of course, you've got a lot of stuff in with 13 or 14, 15, and 16. 14 students struggle with. If there's a second chapter, the second hardest chapter in the textbook, from my experience, it's this earnings per share chapter. You know, I'm not sure why. I have not spent a lot of time on this in my career. Of course, I've read a lot about it, like you are as well. You know, the interesting part about this chapter is there's no journal entries, right? I know some of you say you hate journal entries. I'm not sure how you're going to make it in accounting, though, if you don't like to do journal entries, because that's, in essence, what you have to do when you're looking at going through transactions and deciding whether or not that requires a journal entry or not. Obviously, if you're paying people, whether it's employees or accounts payable, that's automatic that you make journal entries for that. But other things that you're constantly thinking, again, those 12 principles, the last 5 of which you're going to write the gap paper on, that's what you're always thinking about in your mind is, how am I impacting my financial statements, my income statement, my balance sheet? But interesting enough, this chapter is really a math chapter. So some of you may like it, but again, if there's a chapter that's the second hardest chapter in this text, it's probably this chapter, which means you should study extra hard for this chapter. All right, number 5. Interesting problem here, rather short. It says Knox has asked you to determine if this proposed issue of convertible debt will have dilutive effects on earnings per share. You know, that's where it sounds like they're trying to manage earnings, aren't they? If it proves to be dilutive, because nobody wants their earnings per share to go down, everybody might start selling the stock. The company may consider an alternate vehicle to finance the $13 million. Basic earnings per share is given $16. The convertible debt will be issued on April 1 at $13 million par value. So that's mid-year. It's a good exercise. So you got, what, 9 months, 9/12 of this interest to consider. Pays interest rate at 7%. So 7% of $13 million is the annual amount, but we got to multiply that by 9/12. And it's convertible into 270,000 common shares. So that's your denominator increase. And how much is your numerator increase going to go up net of tax? Just the easy way, quick way. There's my 13 million, 7%, 9/12. So you got 682,500 for those 9 months for that year. And so 1 minus the tax rate, 80% of that 682.5 says I'm going to save $546,000. So I'm going to add that to my numerator, and in my denominator, those 270,000 shares, right, for the full year, right there. You don't add 270, you're going to take 9/12 to get the weighted average. So what's 546,000 divided by 2025? There it is. You plug it in. $2.70. The convertible debt will be diluted because the incremental per share effect is less than the basic earnings per share. I told you basic earnings per share is 16. So if it's 16 and this individual change, this what if it's 270, obviously 270 is going to lower that 16 to some level. That's a good exercise. And you have to use a notepad or a smart pad. All right, number 6. All right, here's one that I talked about in the PowerPoint lecture of how you want to do these calculations separately, and then you sequence based on what's the most dilutive to the least dilutive. All right, so let's look at this. I don't have to write all this down as well to walk through this, but there's fewer exercises in this chapter, I will do that. And it's a rainy Monday here on the 3rd floor of Sam Wilson, and I'm probably the only one in the building. Everyone else is taking cover, I guess. Net income is $8,112,800. 30% tax rate. Net income. $1,021,100 shares outstanding for the entire year with an average market price of $30 a share. Why is that relevant? Because we got to use that when we do the options that is in this problem. What other information is there? Oh, a whole bunch. All right. There are three potentially dilutive securities. FOI options to acquire 98,400 shares. At an exercise price of $21. Exercise or strike price. So these are in the money. $30 market price is in the money, right? That's above. Means what if? It's likely they could be converted. Stockholders' equity section of the balance sheet includes 85,600 of preferred shares, and it's convertible preferred stock. So all this stuff's convertible. Declared dividends of $6.10 for the year. Each preferred share is convertible into 1 share of common stock. And they also issue 6,570,000 face value, face value 7% bonds. And each bond is convertible into 88 shares of common. Okay, a lot of data there. So let's go through and calculate each of these to see what our ranking order is. Of course, we don't have to do weighted average. That number's the same. I don't remember reading anything. So the 102,100, they've already handled that for us. All right. Individually, let's first do preferred. So preferred dividends, they said, this is preferred, 85,600. The dividends are $6.10. So 85,006 times 610 is $522,160. That's my preferred dividends, correct? And so if I divide that by my number of shares, 1,021,100, I think. That is 51 cents dilution, which should be our answer over here. Oops, what did I forget? I knew there was something there. I'll follow my format. Got that in my conversion, right? And my conversion, I need to add 85,600 shares to my common, right? Because they were converted at a 1-to-1. Sorry about that. This is live programming, no notes. $1,021,100 plus 85,600, $1,106,700. So 522,160 divided by that says 47 cents. Is that right? I don't remember that number. What did I do wrong? Oh, we're doing this individually. I'm sorry. Oh my goodness. What am I thinking? Need a break. Let's just clear this off and start over. I'm doing so well. All right, so we're doing this individually. I don't need to be concerned about the common shares outstanding whatsoever. So if I've got 85,600 shares of preferred times 610, that part I did get right. 85,600 times 6.1, 522,160. All right, and the number of shares that are being added is 85,600. So that's divided by 85,600, right? Because we're doing this individually in order to rank these. 85,600. That is $6.10. Well, that's just the amount of the actual dividend. All right, duh. 522,160 divided by 85,600. Didn't really think of it in terms of that, but $6.10. So $6.10 is preferred stock. All right, what about the bonds? The bonds are 6570 000 times 0.07 $459,900. Right, that's my interest expense times 1 minus the tax rate. And the tax rate is 30%, so that times 0.7 is going to result in an increase in my denominator of 321,930. So how many shares of common will that be? Well, it also says on here 6570 is the number of bonds. If we've got 6570000 $1,000 bonds, and that says I've got 6,570 bonds convertible into 88 shares of common. So 6570 times 88 is 578, 160. And so 321,930 divided by 578, 160. Can't read my writing. Looks like that is 56 cents. Yep, 56 cents. All right, so the last one here are the options. If I can get all that on one page here. So the options are 98,400. The exercise price is $21 a share. So this is the cash proceeds, 206,400 proceeds. I'm going to receive that from the people that I've given these grants, these options granted to. They've got to pay me 200. If these were converted, they haven't been converted, but if they did convert them, they would pay me 206,400. Well, 206,400 divided by the market price, which was $30, tells me that 68,880 is the number of shares I can buy on the market or use from treasury stock. So 98.4 minus the 68,880 is 29,520. And that's going to be the change in my denominator. But there's no change to the numerator because these are options. So that's just, obviously that's always dilutive. So that's going to be number one. All right, number one. What's number two as far as dilution? And what's number three? Because that's not even a calculation. It's just null, right? Let's go back and look. First is employee options. See, there is no change in income, no change in the numerator, change in the denominator, 29,520. All right. Convertible debt is second, and third is convertible preferred stock. So when we go through and write that then, you can take the numbers that we just worked on there and do this chart. Our net income, which is given, 8,112,800. Preferred dividends, we calculated. Net income, because we're going from top to bottom, it's going to show more and more what the dilution is. 75.9640 divided by 102.100. There's my basic earnings per share, 7.43. All right, the ranking, number one's options. Obviously, that's diluted, $7.22. After you add it in to each of the, or to the denominator, the numerator doesn't change. So now you're to 722. Next is convertible debt. There's what we just calculated, 321,930 that you're adding back. There's your denominator. And so now we're down to 486, and then look what happens on number three, the convertible preferred stock. All right, when you add that back to my income and add that to my denominator, I've gone from 486 to 492. Fancy dilutive. So that's where you've got to be able to do these individually and write those in order to see which securities are dilutive and which are not. You don't combine them all together and just throw it all out there under the what if. You have to do it individually. You have to sequence that. All right, you can finish that part B as well. There it is, if you want to see the answer. Delete all these little marks I made. All right, one more exercise, number 7. I'll have to write all this down as well. All right. Can't write with the magic pen though. Net income is 4510. Weighted average shares is 2740. We don't have to worry about doing weighted average number of shares. Options outstanding for the whole year are 1584. Average price of the company stock is $33. That's market price. They've got $20 per share. A common stock at $20 per share. I guess $20 per share is the strike price. Not real clear there, are they? So these are in the money. In the money options. We've also got 91,000 shares of non-convertible preferred stock. But we do have to calculate the dividends, don't we? $1.60 a share dividend. 30% tax rate. I think I've got everything. We'll see. All right, basic earnings per share. Net income, 4510. Weighted average shares, 2740. Preferred dividends. $91,000 times $1.60. $145.6. $1.59 basic earnings per share. Here it is. Let's see how we get $1.30 on the diluted earnings per share. Well, we've got these options. As you might say, this is an options problem. So we got 1584 options, shares of stock. $20 is the strike price of that times 20. Is 31,680. Potential cash proceeds, where your executives are buying these options because they're in the money. 31,680, so we want to divide that 31,680 by the market price, treasury stock method, corporate buybacks. So 31,680, 31,680 divided by 33 is 960,000 shares. All right, and so we want to take that 1,584, subtract that. We get 624,000. So my basic earnings per share, to get diluted earnings per share, all I have to do is add that 624 up here. And so what is my diluted earnings per share? $27.40. $1.30 or $1.29. $1.30. 1.297. There's my net income, basic earnings per share, and diluted earnings per share. Options. Diluted, basic. So that is chapter 20, earnings per share. Hope you've learned from going through this. You had the advantage of backing up and reviewing any of these exercises that you don't understand. So we will stop there, and next time we'll jump into chapter 21. Hope you have a good day.